I'm Samantha Rowan, and this is Refi TV. Joining me in the studio today are Noble Carpenter, a managing director in Jones Lang LaSalle's Real Estate Investment Banking Group, and Ken Rivkin, a managing director in charge of the commercial division at REDC, more commonly known as Auction.com, to discuss commercial real estate loan sales. Thank you so much for being here today.
It's a pleasure to be here.
For my first question, I'd like to talk about how much distress the commercial real estate sector is still facing.
According to the Moody's Property Index, real estate values have fallen 43% from their peak in 2007, and now we're at 2002-2003 levels. The main issue confronting the market is that many of the properties were financed at much higher debt valuation levels. Segmenting the $3.4 trillion commercial mortgage market, FDIC-regulated institutions have exposure to about $2 trillion of commercial mortgages, and they expanded their loan portfolios, doubled during this decade, with a big push into construction lending, which obviously is more at risk. Looking at their portfolios today, they have loans which are either not paying or non-accrual, $259 billion, which is about 15% of their commercial loans outstanding, plus another $36 billion of distressed real estate. This is about 2% of the capital base for the U.S. banking industry. The second largest source of capital is CMBS, with outstandings currently about $650 billion. About 73% of that number was originated with vintages of 2005 to 2007, which arguably with much higher valuations. Of the current outstandings, over 12% is considered distressed, about $76 billion. So if we add up the above numbers, the minimum problem we have today is in excess of $350 billion. Compounding the problem, real estate is a lagging index, and we should expect property values to continue to exhibit decreasing cash flows. And looking at all the evidence today, there is certainly no slowdown in the amount of new distressed mortgages coming every month.
Well, those are some pretty big numbers in terms of distressed mortgages that are out there. I'm interested to find out, are you guys seeing more distressed properties coming to market, or are banks and financial institutions still playing extend and pretend?
Most of the financial institutions have fully ascertained what the situations within their portfolios, and they have done a very good job of identifying which loans are in trouble, going to be in trouble, and have begun to very actively manage their portfolios and manage out some of the non-performing loans, the sub-performing loans. I think we're at a point now where the financial institutions have really determined that we're back to a point where there's deal flow again, and the financial institutions are trying to move on, get back on the front foot, and get back to making new loans again. And they're very interested in trying to alleviate the amount of mortgages they still have on their balance sheet from these legacy loans. We're seeing more and more, for instance, we're in the market with a $450 million auction right now for hotel loans.
Oh, wow.
And we're seeing a ton of interest in this portfolio for these assets. We have large full-service hotels, and we have select-service hotels, and there is just tremendous investor interest in this portfolio, thinking that this is a sector that is actually poised for rebound. We've seen all other types of product type come out and be sold via the auction platform as well, from office to multifamily, to retail, mobile home parks, industrial, and even medical office buildings.
And it's certainly showing up in the statistics. In CMBS land, special servicers were liquidating last summer an average of 200 loans per month, and that's up from 15 assets a year ago.
That's a huge jump. How are auctions helping banks and special servicers and other institutions move these loans off their balance sheets?
Auctions are proving to be a very effective tool to move assets when executed well. Auctions need to be well advertised for our own platform. We do both national and local advertising to get both institutional as well as retail buyers involved. It's a pretty simple formula. The more buyers, the higher the price. Actually, the auction process allows everyone equal footing to have last look, so people can bid higher than the other parties, which maximizes proceeds. In opaque markets, both buyers and sellers like the auction process because that determines what fair value is, so both parties walk away with the process. With our auctions, we have a non-negotiable closing process, so when an asset does sell, it does close. And then one of the most compelling reasons for an auction is the timeliness. With our process, as well as other probably auction companies, it's 60 days between listing and closing. And the statistics show that the longer that a financial institution has a mortgage or a piece of real estate in their balance sheet, the larger the loss.
Now, what kind of financial institutions are willing to cut their losses and actually sell their loans via auction?
Well, it's funny, if you look back, the types of institutions that have been active selling their loans has really morphed over time. At the end of 2008, there were just a handful pioneering banks that were selling loans, and that was really it. And then when you get into 2009, the stress test results came out in May of 2009. And really nothing happened until those stress test results came out. Once that came out, people knew what the game plan was. People had some confidence in the financial system. What we began to see were really the special servicers bring their loans to market first, and their non-performing loans to market first. And a handful of the banks, some of the more healthier banks that wanted to get back into the origination business and clear out their legacy bad loans, they've been coming along since then, but it was really the special servicers. They were the pioneers leading the way. Now you have the banks and the financial institutions coming along, and right now there's pretty good participation across all industry participants selling loans on the auction platform and clearing and using the secondary market to clear their assets.
It seems like the pipeline has really changed over the past year or so, then, the pipeline of kinds of assets that are coming to
Absolutely.
market.
When we look at our pipeline now versus a year ago, I would say it's 2.5 to 3 times larger than it was a year ago. So we're feeling pretty good about where we're going, although I wouldn't say the deal flow is not a deal flow that we're happy with, but it certainly feels a lot better than it did a year ago.
Yeah. In talking to people in the trenches, people closest to the real estate, the feeling is that the prices that they're getting are very, very high, and this is a good time to sell. Some institutions are limited on their capital base, so the stronger capitalized banks seem to be good sellers taking advantage of the strong bids. The capital impaired banks don't have the flexibility, so they are doing more the pretend and extend.
Now that leads me to my next question, which is how much of the original loan balance can actually be recovered through an auction?
Yeah.
Is there a market average on that?
Yeah, there are averages, but there's variance too. Our recoveries range from pennies on the dollar to par for non-performing loans, and it's a function of the underlying real estate coupled with the foreclosure laws. In judicial states, it's a little bit less. On the non-judicial states, it's a little bit more. The discount between the underlying real estate value and the loan is very, very low due to the aggressive bid from non-performing note buyers. That said, our average recovery is in the low to mid 50s. And how does that compare to other pools? The average CMBS recovery is in the low to mid 40s, with the exception of last month, where it was reported it was 30% because of some 100% lost loans.
The underlying real estate value is really what drives the recovery value as well, in addition to the laws. You can't, a lot of people want to know, is there a percentage of par they can expect? And there is no real percentage of par that you can apply generally across the spectrum. It really is driven on each deal individually, has to be evaluated along with the terms of the loan documents in terms of with regard to whether you have recourse or, as Ken mentioned, if you're in a judicial versus a non-judicial bankruptcy state.
And also, we talked a little bit about a hotel portfolio that you guys were working on earlier in the interview. I was curious to find out what other sectors do you see improving in the coming year?
Well, certainly I think hotels are going to be recovering. We've seen that already this year. Occupancies are well up in 2010. And that's primarily because they have daily leases. When you, I think the other sectors, what we're seeing recovers. I think we're going to begin to see a rebound in 2011 in some retail and the office sectors as well. Multifamily is a sector that people feel very good about. It is beginning to rebound. There hasn't been a lot of construction in the last few years, and as a result, many markets that have not had a lot of new supply, people are anticipating strong rental growth in those markets. So I'd say first, foremost, probably hospitality, and then secondly, multifamily, followed by retail and office.
Sure.
And geographically, I put my chips where there's job growth. If there's one statistic that's correlated with real estate, commercial real estate, it's job growth, GDP. So we have the jobs, you have the people to fill up the office buildings, to rent the apartments, and shop in the retail centers.
Are there any particular regions? Is that the southeast or is it the northeast? Like what kind of regions are you seeing that kind of growth in?
I think the southeast and the Midwest are the two areas that have, people talk about the sand states, I guess that would be southeast and southwest, but it's really where we're seeing the most distress right now is really southeast, Florida, Georgia, Louisiana, that sector, as well as the Midwest, Ohio, Michigan, Indiana, Illinois. I think there's just going to be stronger potential for job growth in the Southwest, and I think that will probably have a better chance of rebounding as a region versus those other two regions.
And now just to shift gears a little bit, how many notes and properties have been purchased since you guys began work in this area?
Year to date, we have sold 280 notes, 80 plus notes totaling in excess of $1 billion, 80 plus properties. Based on our listings through the end of the year, we expect a monthly volume of $600 million of notes and in excess of 100 properties.
How many visits are you getting to your website? Has that been increasing over the last few months?
Yeah, with the website we get 600,000 plus visitors a month, auction.com. For a typical auction we get 60,000 plus hits, and typically 3,000 people enter the data vault to do fundamental research on the individual assets.
Now, we've talked a little bit about how special servicers and financial institutions have been some of the people selling loans via auction. Are auctions a solution that the FDIC or any other governmental agencies are considering?
Yes, we've been speaking to the various government institutions about the auction process, and there are ongoing discussions with them, and it's a very viable approach, and we're hopeful and optimistic that they will continue to consider it and use it.
Thank you. That's all the time we have for today. I'd like to thank you both for being here.
Thank you, Samantha.
Thank you.
And I'm Samantha Rowan, and this is Refi TV.